All right, let's get into what the 2-1 temporary buy down is. There's a lot of misconceptions out there, and this is a very popular product, definitely considering the current real estate and mortgage market. So let's get into what this is. All right, so let me make this a little bit bigger for y'all. A 2-1 buy down, it's a temporary buy down. This is not an ARM. This is not an adjustable rate mortgage. This is the 30-year fix just with a temporary buy down. And this can potentially save you thousands of dollars. So real simple math. The first year, the rate is 2% lower. The second year, it's 1% lower. And then years 3 through 30, you're back to the normal note fixed rate. Okay. So how does this work? Right now, seller concessions are paying for this with the lenders that I work with. Other lenders are different, but when I'm talking about the lenders that I work with, and this is the most popular way that seller concessions are paying for this. And we're seeing that a lot more in this late 2022 real estate market where houses are staying on the market a little bit longer. Sellers are willing to give seller concessions to help move them. And so again, like what that looks like is the buyer's first year payment is 2% less. The second year is 1% less, and then it goes back to the 30-year fixed rate. What does this apply to? This applies to conventional FHA and VA purchases for primary and second homes. So this is not investment properties. These are as of right now, these are not jumbo loans or USDA loans. A lot of benefits for the sellers. For one, it attracts more buyers. There's some buyers that are wary right now. They're wanting to sit on the sidelines. Oh, rates are a little high. They're in the 6s or 7s or wherever they are at. We don't know if we're ready. This helps them ease into those payments and faster closings, and you can receive offers before you have to drop your price. It's not uncommon right now for a $500,000 or $600,000 house to drop price $20,000 and then another $20,000 or whatever it is their strategy is. This helps you for doing that as a seller, and you can negotiate with the buyers, to adjust the seller concessions up or down. For buyers, we've already talked about the big benefit to this, right? You're going to save hundreds of dollars monthly for those first 2 years, which is going to add up to thousands of dollars. And we're going to get into what this looks like here in a minute. We're going to show you the actual numbers. You're not paying for the rate buy down. So a traditional rate buy down, when you purchase discount points, that's a sunk cost. Now, in a year or 2 years later, if you refinance and you haven't fully hit that break-even point, well, you don't get that money back. It is a sunk cost at closing. This is not that way. When you do this 2-1 buy down, basically the money's being held in like a temporary escrow account, if you want to think about it in that nature. If you refinance, say after a year, right in the middle of the 2-1 buy down, you don't lose the concessions that haven't been used yet. They actually get applied as a principal reduction and reduce your loan balance on the refinance. And then this helps keep values higher, right? This helps keep appraisal values higher for the community. And there's no prepayment penalties. If you were to refinance, if rates were to drop faster than expected, you're not going to pay a penalty. And, you refinance if it makes sense. And then as an agent for my realtors, this generates interest right away and helps start moving those listings quicker. This demonstrates that you're motivated, you and your sellers, and it may have to prevent you from having to drop the price and reprice later on down the road. So in the end, it's just an extra tool that you have in your back pocket if it makes sense for your buyers. And so let's look at some real numbers here. Let's look at a real case scenario. So this was some pricing that was as of 10/25 with United Wholesale Mortgage. This was a conventional purchase, $500,000 purchase, putting 5% down, so a $475,000 loan amount, 740 FICO. All right, so these numbers are just the principal and interest, but look at that savings. On year one, when you're 2% lower, you're saving $620 a month. That is significant. The second year, you're saving $317 a month. So for a total of $11,250 in savings over the first 2 years alone. Significant savings. Let's compare all three. Over here on the regular loan, this is your regular principal and interest. This is a $500,000 purchase putting 10% down. So this is based on a $450,000 loan amount and 7.25% interest rate. Again, I'm not quoting interest rates. I'm just showing you some scenarios. If the seller was to price drop, if the seller was to just do a traditional $15,000 price drop right here in the middle, you see that that's a $485 price point, and you're saving $94.45 a month with that lower price point. Over on the right, we have the 2-1 buy down. So you're saving over $10,000 those first 2 years. And as a seller, if you're on the seller side, rather than drop $15,000, you're only giving $10,658 in concessions. So you're netting almost over $4,000 more than if you were to price drop. It's win-win. Win for the buyers, win for the sellers. And if you were to do a traditional buy down, if you were to just take that $10,658 and do a traditional buy down and buy discount points, in this scenario, it gets you down from 7.25% interest rate down to 6.5% interest rate. You're saving $219 a month. So still not nearly as attractive as doing the 2-1. You'd have to hold on to that mortgage a lot longer to recoup that initial $10,000 for discount points. And nobody has a crystal ball, right? But most industry experts think within the next 12, 24 months, there's going to be some refinance availability when prices drop. So if you have any questions, please reach out. Let me pull myself back up here. If you have any questions, let us know. Thanks.